Hi, thanks so much for tuning in. You're watching DQ Prime, and we're speaking about crude oil prices. If you've been looking at the markets recently, you will have noticed that they've dropped considerably in the recent past, of the last couple of days or so. They have, in fact, fallen to a low from as back as January, the lowest point since January right now. It's below $85 to the barrel for Brent crude. We're trying to understand why this recent move has come in, and we're also trying to analyze whether or not this is going to stay the case in the near term, where the crude oil prices are going to be a little soft, or whether they'll come back in a big way. I've got Peter Mcguire, who's the CEO of XM.com, and we've also got David Lennox, who's a resource analyst at Fat Profits, joining in. Gentlemen, thank you so much for taking the time. I guess the most important question that people are going to be asking is why is crude falling after having stayed elevated for much of last year and the beginning of this year? David, I'll come to you first. What's your analysis telling you?
Well, look, certainly if we have a look at the market, one would suggest that one of the key reasons we're seeing the crude prices come off is the fear of recession that's now really starting to rapidly grow inside most rhetorics that we're hearing from. That fear, if we do see a recession, we'll obviously see demand destruction inside the oil sector. And with that demand destruction, we would expect to see weaker prices. At this point in time, we've heard little comment regarding supply. So with the destruction there and likely coming now, then we're seeing the crude prices react accordingly, drifting well away from that $100 where it did stick tenaciously to for some time, and now trading down into the mid 80s US a barrel. Sorry.
Do you believe that that's the case, Peter? Is that something that you've looked at as well? And is this something that is durable, or do we see a rebound?
Well, I think a couple of things, Alex. First off, building on what David mentioned, yes, certainly the demand destruction component. We have to also add US dollar index, now sitting at about 114. Put our minds back only a couple of matter of weeks ago, and you're at 105, 106, and maybe we hit 107. Have a look what's happened to the pound in the last two trading sessions, or today and naturally Friday, and we've got a long way to go yet till New York closes for Monday. And we've nearly had parity in one day from 112 to 103, demonstrates the fragility of the market and how the inflation story is really a nightmare on Elm Street. How do you control it? The central bank's views, currencies are being crushed as we speak. Euro at 96.96, no one could put their mind to it. Yen at 145, intervention from banks. So you will see that demand destruction. There's no doubting that. You will see also, I've got to say this, a midterm election only 5 weeks away in the States, or 5.5 weeks. So that's all creating, I think, more ranks, pushing down price, US dollar going to boom to the upside. And then naturally, I think that probably the recessionary fears are biting on Main Street so heavily. So I'm not sure how the inflation story is in Mumbai, but certainly in Sydney, it is absolutely, I would say, dire for the average consumer on Main Street that hasn't had a pay rise. Your $100 of shopping basket a year ago is now costing $130 or more. So it is frightening. Food prices,
no, it is certainly.
fuel. Yeah,
it is certainly, Peter. I think the world over, inflation is something of a problem, but in terms of the rate of inflation here in India, it's actually lower than a few developed countries, yours included, I think. But I will come to you, David, on the outlook from this point on. Quite a few points that Peter just pointed out had to do with demand destruction in several economies, but one key element is going to be the supply side, right? You've had the oil-producing nations that have adjusted the flow of crude in the market according to what they see as the demand picture. Is that something that will kind of push prices up as well?
Oh, yeah, there's no doubt about it. If we do see OPEC start to perhaps move higher with its wind back of the cuts that it made during COVID, that would impact on demand and on supply, and that would see extra supply coming on stream. and the prices would continue to trend lower as we see them at the moment. Look, the real big player, however, is not really appeared in any earnest way, and that's US production. We've seen shale sort of, I guess, plonking along at a moderate pace, but it hasn't really started to rise yet. And one would expect now that we've seen the oil price backing away from 100, we won't be seeing that sort of production coming on stream in the near term. So one would expect that supply is going to remain quite tight. So you would say that that should at some point in time start to put a floor underneath the current demise that we're seeing. However, as we've said already, it is the demand side that really can very quickly be destroyed by a recession. And of course, throw in what's happening in China, one of the second biggest consumer of energy products. And we're probably getting a little foretaste of perhaps what a global recession could do with energy demand. So we do need to see OPEC being quite diligent and perhaps winding back those cuts rather than taking them away. Rather than implementing. So perhaps implementing more cuts rather than bringing in more oil back on stream. So it is really a mix of information and data out there.
Absolutely. I want to take that point that David made, Peter, on China, and I want to ask you how big a factor that's going to be in the coming couple of months. And then I'm going to also ask you, to put the dollar down, I guess, and to tell us where do you see crude oil prices over the next couple of months?
Well, I think first off, the Chinese situation is, if you buy into the story as far as the property market representing 32% of the overall economy and how fragile it is, and mortgage holders not paying paybacks or their mortgages, then if that is as severe as what the analysts that I read their storylines, I would say that the next matter of months are going to be a real emperor going into the water and see if they've got any clothes on, because that's where we're looking at the moment, the absolute meltdown of Chinese property market. If that was to materialize, Alex, then I would think that would really put a massive handbrake on not only the Chinese market, but certainly from an energy consumption standpoint, but the debt and the contagion across international banks and domestic banks in China, that would be very, very worrying for the global economy and the fragility that it stands at the moment. So there's the first part. The second part is how much lower can prices go? Yeah, you might see WTI, I've got, it's sitting at 77.80. It's difficult to speculate, but I won't be surprised if we see 70, if not high 60 for WTI. Probably Brent, maybe it might touch down to 75 on the low side. It's hard to speculate how much further it can go down, but the US dollar index sitting at 114, are we going back to what we saw in September 9/11 and a 120 handle for the dollar index? And if that's the situation, then yes, I think that's going to also add serious impacts as far as energy costs globally.
Okay. David, your view on crude oil prices, and I'm going to get a very quick view in from the both of you on gas and a couple of other commodities as well. But first, where do you see prices going for crude oil?
Look, certainly at this stage, yes, we think the trend is down and it's going to continue, but we're perhaps not quite as pessimistic as Peter is, because we think that there's going to be some activities from a number of governments to just try and balance out various parts of their economy that aren't functioning so well, particularly China. And if that's the case, then we will see, we think, more of a floor coming into the Brent price. And as I've said already, I don't think OPEC are very comfortable with the oil prices where they are at the moment. So we're likely to start seeing them take some action to withdraw production rather than bringing production on stream. And that will also put a floor under the prices. But look, overall at the moment, you'd have to suggest most of the news that we're well aware of, that is a recession's coming or we're already in it, is probably now already starting to be priced in. So there's probably not a lot of downside left unless we do see some sort of shock coming out of the economic system. And it's easy to see where those come from. It's just a little difficult to see what that shock might be. But look, they are there. We've had the Chinese property market. So there's little shocks coming out everywhere. And that's what could cause the price to stumble. But we don't think that it'll stay low for any significant period of time.
Okay. Final thoughts then, David, I'll come to you first on the other basket of commodities that you look at. Of course, there are certain aspects with regard to gas, which is primarily production linked and geopolitics linked. But what other key trends are you watching very closely in the commodity space?
Well, I guess we've already talked about the key one, and that's that rascally US dollar, sitting up where it is. We thought the US dollar would have rolled over by now. The metrics are there in terms of rising debt, slowing GDP, but all our peer currencies are doing worse. And they're just not pulling their weight in pulling that US dollar down. And while that's the case, I'm afraid that dollar is going to reign supreme, and it's going to reign supreme over commodity prices, which will make it very difficult for them in any form or extent to rally unless we do see something happen with that dollar. I'm afraid the commodity prices probably for the remainder of this year are going to lament somewhat. But again, the downside does seem limited. We have seen supply somewhat constrained and demand still is there. It's just that US dollar.
Peter, is that your view as well? I think from the conversation we've had so far, you're a little bit more bearish on the prices than David is.
Well, I'm bearish in the sense where I won't be surprised, but remembering, what we're going to take on board, Alex, we've got Mother Nature issues that could absolutely cause havoc in the Gulf region with the hurricane there. Just let's just say that plays out. Secondly, we've got the situation with Ukraine and Russia seems to be escalating every day. So we've got some major geopolitical issues and Mother Nature issues on our doorstep that can change the footprint of price very, very quickly. So whilst I say, yes, we've got the potential to hit a high 60s, and I won't be surprised, I don't think it's going to stay down for that much longer. I think it's going to be very wild and whipsaw. That sort of, you see those big 5% blowouts each night. We've got a US dollar moving very strongly to the upside. Let's see what happens if that goes back to 110. That's going to take a little bit of heat back into the commodity markets. Everyone's dollar centric at the moment.
All right. So that's the watchword really in the commodity space. We're all looking at the dollar index to see how far it goes and where it goes from here. But at least for now, crude oil prices seeming a little bit soft, a little under pressure. Thank you so much, gentlemen, for contextualizing all of that for us. And thanks so much for speaking to BQ Prime.
Thank you, Alex.
Thank you.